Tax group. This article outlines the concept of tax groups under the UAE VAT law. It explains who can form a tax group, the conditions that must be met, and the powers of the Federal Tax Authority, FTA, to approve, reject, modify, or deregister such groups. The purpose of tax grouping is to allow related businesses to simplify their VAT administration by registering together under a single tax registration number, TRN. 1. Who can apply to register as a tax group? 2 or more persons conducting business in the UAE may jointly apply to the FTA for tax group registration if they meet all of the following conditions. A. Place of establishment or fixed establishment. Each of the persons applying for tax group registration must have either a place of establishment, their primary place of business, or a fixed establishment, a permanent physical presence where business activities are carried out, within the UAE. B. Related parties requirement. All persons within the proposed tax group must qualify as related parties. This generally means that the businesses have common ownership, shared control, or significant economic ties, ensuring they operate as part of a larger economic entity. C. Control within the group. 1 or more persons within the tax group, operating within a partnership or similar structure, must exercise control over the other members. This ensures that the group functions as a single economic unit. 2. Authorities' power to reject tax group applications. The executive regulation will provide further specific conditions under which the FTA may reject an application to register as a tax group. This ensures the FTA retains the ability to prevent abuse or improper tax group formation if the relationship between the businesses does not meet regulatory expectations. 3. One tax registration number per person. In general, each person conducting business in the UAE may only hold a single tax registration number, TRN. The only exception to this rule would be if a specific case is provided for under the executive regulation. 4. Mandatory grouping by the authority in certain cases. If related parties meet the conditions to form a tax group but fail to voluntarily apply, the FTA has the power to assess their relationship based on their economic, financial, and regulatory links. The FTA may forcibly register these related parties as a tax group if it verifies that their relationship qualifies under the executive regulation. 5. Deregistration of a tax group. The FTA also has the authority to deregister a tax group if certain conditions specified in the executive regulation are met. This can happen if the group no longer qualifies, if the businesses cease to meet related party criteria, or in any other circumstance defined in the regulations. 6. Modifications to tax group composition. Once a tax group is registered, the FTA can make changes to its composition. These changes can involve A. Adding new members to the group. B. Removing existing members from the group. These changes can happen either at the request of the taxable person representing the tax group, or directly by the FTA itself, if circumstances defined in the executive regulation apply. For more details, contact us.